All right, let's jump right in. If you're someone who believes the future really belongs to those mega cap innovators, the giant companies with insane balance sheets and endless R&D budgets, then you are in exactly the right place. Today, we're going to do a real deep dive into QQQM, which might just be the modern way to invest in that exact idea. Because that's the real question, isn't it? It's one thing to believe in the story, but it's a whole other thing to know the smartest, most efficient way to put your money behind it. And that's the puzzle we're going to solve together in this explainer. So here's our game plan. We'll start by framing the core problem for investors today. Then we're going to pop the hood on the NASDAQ 100 to see what makes it tick. After that, we'll look at the good, the bad, compare QQQM to the other guys, and wrap it all up with a clear verdict and a playbook you can actually use. Okay, so let's set the stage here. The big idea we're running with is that the largest, most innovative companies are just going to keep leading the market. We're talking about the names that are literally building the future of AI, the cloud, the whole digital economy. The dilemma is, how do you get pure, concentrated exposure to them? And that brings us to the main event, QQQM. Now, this is an ETF that tracks the famous NASDAQ 100 index. Yep, the same one that its older sibling, QQQ, is famous for. But, and this is a big but, QQM is really built from the ground up for the modern, cost-conscious investor who's in it for the long haul. So to really get a handle on QQQM, we have to look at the engine it's built on, right? That's the NASDAQ 100 index. What exactly is it, and why is it put together the way it is? Let's find out. At its heart, the NASDAQ 100 is a pretty specific slice of the U.S. market. It takes the 100 biggest companies listed on the NASDAQ exchange, but, and this is the crucial part, it kicks out all the financial companies. This is done on purpose, and it gives the index this really heavy, intentional lean into tech, consumer platforms, and communications. This table really makes the choice crystal clear for any new investor. Look, both QQQM and the famous QQQ track the exact same index. They hold the same stocks, but QQQM is just cheaper. The expense ratio is lower. Plus, it's a modern ETF, which is usually a bit more efficient. It's really like having the same powerful engine, but paying less for gas. For anyone starting today, QQQM is pretty much the no-brainer choice. Now, this part is honestly brilliant. The NASDAQ 100 has these built-in safety rails to keep things from getting too crazy. These rules are there to stop any single company, or a tiny group of them, from completely dominating the fund. And this isn't just some theory. We saw it in action back in July 2023, when they triggered a special rebalance to trim back the megacaps. It's a proven system that's there to protect you. So we know how it's built. Now let's actually build the bull case. Why should you seriously consider making QQQM a core piece of your growth portfolio? It really comes down to three big things. First, you get pure, no-fuss exposure to that whole innovation theme. Second, those adaptive rules we just talked about, they've been battle-tested. And third, the low cost is huge. That 0.15% fee respects your long-term returns, letting your money compound instead of leaking out in fees. But hey, no investment is a sure thing, and a good strategy means understanding the downsides. So we have to look at the other side of the coin. What are the risks you'll actually feel when you own a fund like this? Let's get into the bear case. The big thing to get here is that while those safety rails manage the concentration risk, they absolutely do not get rid of it. The top 10 stocks still make up a massive slice of this pie. So what does that mean for you? It means when those giants have a bad day or a bad week, the entire fund is going to feel it. That's a feature, not a bug, but you have to be ready for that ride. And beyond just concentration, there are three other big risks. First, valuation. These are high flyers, and their stock prices can be really sensitive to changes in interest rates. Then you've got sector blind spots. Remember, no financials. That means you could miss out when that part of the economy is doing great. And finally, regulatory risk is very real. The bigger these companies get, the bigger the target on their backs from governments around the world. Okay, so we've laid out the pros and the cons, but how does QQMR actually stack up against the competition? This is where the rubber really meets the road for most of us when we're deciding where to put our money. So first, let's put it up against those broad, large-cap growth funds like VUG or SCHG. Think of it like this. QQM is a high-octane, concentrated bet on the very top innovators. It's going to be a more intense ride. Those broader funds are more diversified, holding hundreds of stocks. They give you a much gentler, less focused exposure to growth. Which one is right for you depends entirely on how much conviction you have in those top names. That's a fantastic question, right? Because a lot of people mistakenly think the NASDAQ 100 is just a pure tech fund. But the reality is a little more interesting than that, and it brings us to our next comparison. And the answer is no. QQQM is not pure tech like a dedicated tech ETF like XLK. A better way to think about QQQM is as a bet on the entire platform economy. Yeah, it's got tech, but it also has huge consumer and communications companies in there. Think digital ads, e-commerce, streaming. XLK, on the other hand, is a much more surgical bet on just software and semiconductors. All right, we have covered a ton of ground. The mechanics, the pros, the cons, the comparisons. Now for what I think is the most important part. How do we turn all this info into action? Let's talk about your verdict and your playbook. When it comes down to it, there are really two main ways you can use QQQM. The first is to make it your main growth sleeve, giving it a pretty big slice of your portfolio, say 20 to 40%. Or if you already have a solid broad market core, you could use it as a smaller satellite tilt, maybe 10 to 20%, to add that extra punch of innovation you believe in. And please remember this. It's so important. No matter how great any single fund is, it should never be your entire strategy. The goal is always to build a well-rounded, resilient portfolio. QQM is just one piece of that puzzle. The right answer is always the whole portfolio, not just one ticker. To make this super concrete, here's a sample playbook you could totally use as a starting point. It's got a total market fund at its core, then adds a 20% sleeve of QQQM for that growth engine. Then it adds some balance with a quality or value fund, diversifies outside the US, and keeps some dry powder in treasuries. And the most important part, it runs on simple rules. Automate your investing and rebalance it every 6 months. So after all that, what's the final verdict? Well, it's pretty clear. If your specific goal is to get concentrated exposure to the US platform economy, then QQM is, without a doubt, the best-in-class tool for that job. Its rules, its structure, and its low cost make it the most efficient way to express that very specific view. I just love this analogy because it perfectly sums up how to think about QQQM. It's not the entire car. It's the powerful, high-performance growth engine that you bolt onto an already well-built, diversified chassis. If you treat it like that, it'll do exactly what you want it to do. And that brings us right back to the beginning, to the final question that only you can answer. Now that you know how it works, what's inside, and what the risks are, you get to decide. Is this powerful, concentrated growth engine the right addition for your portfolio?